Yeah, so as Mark said, we founded Asset Match 12 years ago. You've all got or will get the slides, I'm sure. And I don't intend to just go through this. And by the way, if you want to ask questions as I'm going, feel free, because there'll be elements of this and then we'll move on. But the genesis of the business was a company many of you would have heard of called Integrafin, which has a pension wrap platform called Transact. And my co-founder was a shareholder an early investor in Integrafin. And in about 2012, Integrafin had been going for 10 years, been highly successful, was paying a dividend, had 450 shareholders, and there was no facility for liquidity in the shares. And we did some research to find out quite how many companies there were like that in the UK. And there were a significant number then. And it's a number which has just grown and grown. The much documented problems of IPOs has meant companies can't go public as quickly as they like. The equally well documented problems with companies finding AIM quite a tough bedfellow and deciding to seek alternative liquidity arrangements. So it's become a huge sector. As you can see, we have now approaching 50 companies on the platform. They vary in size enormously, from companies which are 1 or 2 million market cap to Tottenham Hotspur to Brewdog. So a vast array of companies in different sectors, different size, and with different numbers of shareholders. Brewdog is a great example. I think it now has 235,000 shareholders. And almost all our companies have at least 50 or preferably 100, because you need a sufficient number of shareholders to have a chance of creating liquidity. And as Mark said, we provide the liquidity by running auctions. So when we first set it up, we thought we would have continuous liquidity where people could post bids and people could post offers, and then they'd end up trading. And the more we thought about it, the more running auctions was a logical place to go. I mean, if you think about Sotheby's selling a work of art, it's a fundamentally illiquid asset. So they tell the buyers and sellers to turn up at the same time, and that way you can create some liquidity. So we run auctions in the shares of private companies. The auctions can be monthly, anywhere from monthly to annually, and there is full transparency. Each company, I'm sort of jumping ahead of myself a bit here, so let's go through. So there's an array of some of the companies. We sort of interact with 3 distinct types of companies. There are companies that have been publicly quoted, and for whatever reason it hasn't worked. Tottenham Hotspur, as you may know, were publicly quoted. It ended up being 85% owned by Enic, Lewis and Levy, but it's always had a float of about 15% who need some liquidity. Wadworth's family brewery, lots of breweries going back over 100 years would sell shares to their clients. Wadworth's has about 2,000 shareholders. I don't think they've got any intention of ever going public, but they do need to have a vehicle for those shareholders. And is there anybody in? And then the other one is a sort of Brewdog or a Brompton Bicycle, a growth company that at some stage aspires to be on a public market, but doesn't want to do it yet. As you know, public markets are demanding mistresses or masters, and you need to be in the right place to make the most of that as a company. And I think with the much documented travails, people are waiting a bit longer to do that.
And expense.
And expense. So when a company joins the platform, we build a page for each company which has pretty basic, as much information as the company wants to share with us. It has, the company data, market cap, how many shares are outstanding, company news, all the documents, so it'll have their report and accounts filed with Companies House. And then I guess the important bit is the page where the live auction is. And so it tells you that the auction has got another 29 days to go. The important part is that people can enter orders and amend orders during that entire period. And there's if there is a price at which some shares will change hands, that is highlighted. So you can see here that there's one buyer of 50,000 shares at 260. There are a number of sellers, of which one is 500 shares at 260. So if the auction was to close now, 500 shares would trade at 260. But as the auction gets closer to closing, there'll be more interest. There'll be they'll move towards a closing price, and the important part is that everybody trades at the same price. So everybody who was a buyer, if this auction was to close at 260 and there were multiple orders, everybody who was a buyer at 260 or above would buy. Everybody who was a seller at 260 or below would sell, and they would all deal at 260.
Who's the time limit? Who sets that?
We agree that with the companies when they come onto the platform, whether they want to do it monthly, quarterly, how long they want to have the book visible for. Some companies, Brewdog, were always incredibly concerned that it was there for a very short period of time. Other companies are frankly, agnostic to that. So it's agreed with the company beforehand. So what are the benefits? I mean, the benefits vary depending on the type of company. If it's a company that's been in a public market and has for various reasons decided it no longer wants to be there, quite often it's a question of cost. So we charge between £10,000 and £20,000 a year to be on the platform. When we originally set it up, our raison d'etre was that the beneficiaries, unless you're raising money, the beneficiaries of liquidity are not the company, they're the shareholders in the company. Now, I know those two things are quite closely allied, but in an AIM framework, the company really pays almost all the cost of the liquidity, and the investors pay very little of it. And our view was that we should reverse that. So we charge what for a public market would be a very substantial commission. We charge 3% to all buyers and all sellers, but we only charge the companies £10,000 or £20,000 a year. And that's an important point. If you look at the bid offer on AIM, you'll find that regularly that's more than 10%. So actually 3% aside as the commission is actually very fair. It allows, so we provided liquidity. It allows companies to manage their shareholder base. They can launch buybacks if they want to over the platform. They can do investor presentations. They can present research to try and build their investor base. And they can use it as a investor relations platform using the pages on the platform. So here's Integrafin, which we use, not surprisingly, because it's a perfect example of what we'd like to happen. Integrafin first traded on asset match at a price of £85 a share in about 2014. Over successive auctions, the price went from £85 a share to £250 a share in the summer of 2016, summer of 2017, when the companies announced that they were going to go public and asked us to stop doing auctions. They went public in March 2018 at a price of £500 a share and went straight to £1,000 a share. So the early investors at £85 a share over the course of a 5-year period saw their investments go up tenfold. And actually, those shareholders who sold, it was interesting. And coincidentally, Integrafin ended up with a load of investors who worked in the bond market because of one particular contact. And I remember one of them saying to us as he sold some at about £100 a share, he said, "I hope this is the worst trade I ever make." But he sold 10% of his shares. He wanted some money to do whatever, give the kids some money or something. And so, there are many occasions where taking a small amount of chips off the table makes sense to everybody. FastJet is a company that left AIM. I don't want to belittle AIM, particularly with a company here that's hoping to benefit from it. But it doesn't work for everybody. It doesn't work for, that's crystal clear. I think at the height of AIM, there were 1,700 companies on it, and it's now under 700. So that highlights the difficulties. It's quite an expensive place to be. It has a relatively restricted investor base. We've seen, I think one of the capital markets problems in the UK has been the fact that institutions have become so huge that the average size of an investment, for it to be worth their while doing the work, has become absolutely huge. And given most of them have a 10% threshold on the amount of a company they can buy, you're talking about a company having to be at least $1 billion market cap and probably more like 10 billion before they'll even take a look at it. So it's become a real problem to find an audience for companies on AIM, dominated by high net worth individuals. And sadly, what seems to happen is that a new one comes along, people buy it because the broker tells them it's going to treble. They hold it for a year, it hasn't trebled. The next one comes along, so they sell the first one and buy the next one. And it becomes just a sort of revolving cycle of disappointment. I'm not sure there's anything desperately interesting in that one. This I do want to move on to, because I think this is quite important. It's quite important from an asset match point of view, but I think it's also quite important from a private investor point of view. I don't know how many of you are aware, as Mark alluded to this, to PICES, which, as you can see, stands for Private Intermittent Securities Capital Exchange System. This is a Treasury and FCA initiative. It was initially launched by the last government. I think after the election, with the change of government, there was a sort of expectation that it would fall by the wayside, but it hasn't. If anything, it's been picked up with greater enthusiasm. And so this is a real attempt by the regulator and the Treasury to create a sort of third space where there will be some regulation. So asset match will shortly be applying to become a PICES operator. We are FCA regulated at the moment, but we're not an MTF, we're not a multilateral trading facility, but we will be applying to become a PICES operator. And that will come with some regulatory requirements, but our view and some advantages. For example, at the bottom you can see at the moment transactions that take place over asset match are subject to stamp duty, whereas transactions on AIM aren't. So we will, if we become a PICES operator, we'll get that same benefit. So the objective...
You have to pay stamp duty.
Sorry?
At the moment, pay stamp duty.
Yeah.
Okay.
Yeah, you pay stamp duty on any share transactions, which is not AIM. So we're a big believer in this. We think, so what creates liquidity? At the end of the day, liquidity, there are two ways liquidity is, this is one of my great hobby horses actually, but there are two ways liquidity is provided. One is by intermediaries using their capital, which was for 30 odd years from Big Bang till the financial crash. Is that 30 years or 20 years? Anyway, there was that period where liquidity was created by the balance sheets of the intermediaries. After the crash, there there was no longer balance sheet to create liquidity in anything but the most liquid securities. And that's one of the difficulties AIM faced, because if you look at AIM in 1998, 2000 time, all the big global investment banks were market makers. If you look at the market makers now, most people haven't heard of many of them, and there is no balance sheet. So the way you have to create liquidity is from investors buying and selling, because that's where the balance sheet has been transferred effectively. It's been transferred from the intermediaries to the institutions, to family offices, and so what is critical to creating liquidity is getting more of those people involved. And so we're all very hopeful that having this sort of regulation light segment will help produce that. These are all distributed, these slides.
They will be, yes.
They will be. So if anybody, the contact details of the team are there if you want to email me afterwards or get hold of. And then here's a list of the companies on the platform, and you can see they cover the whole gamut of how they've come to be on the platform. A number of delisters, a number of family type businesses, and a number of growth businesses, and they all have relatively regular auctions, and most of them, the shares trade on a regular basis. Greenshields Agri is a agricultural business based in Scotland, and we've put that in there because they have used the platform consistently over the last couple of years to buy back shares. One of the, it's an important point, and I know a lot of people feel very strongly that AIM or the London Stock Exchange should make it a condition of people leaving that they put in place some sort of liquidity provision, be it Asset Match, be it JP Jenkins, which is our main competitor, but leaving shareholders hung out to dry is not acceptable. But a lot of companies also use it to, some tender as they're about to leave AIM, but others will use the platform to buy shares back.
If they buy back the shares, will we know that they're still?
Yes. Yeah.
You'll see it.
That is indicated. Yeah. Yeah. I haven't really touched on. I mean, we do. It's not the Wild West. We do have a process for companies to join. So there's an application process. We have a rule book. We have directors' declarations, and so yeah, there is a lot of information about who's doing what to whom.
And so the balance sheet.
Sorry, can you repeat the questions, just because there's a mic, there are people online too, so, or alternatively we can.
Yeah. So the balance sheets, income statements, financial statements, they're all coming directly from Companies House, are they? So they're fully reliable is what I'm getting
exactly.
at.
Yeah, they all come from Companies House. Yeah, and we do. So slight historical question. AIM, as you remember, in the mid 2014, 2015, had a bit of a love affair with China, which ended in tears largely. And at the time, we felt very strongly that there was sufficient companies in the UK that we could just do it UK-centric. And more importantly, we were confident that we could do very basic due diligence on a company in the UK, like looking at their directors, like checking the directors on LinkedIn, finding out who we know, who knows a director. Just, very high-level due diligence. We haven't yet. I mean, we've had companies that have been taken over, we've had companies that have IPO'd, and we've definitely had companies that have gone bust. but we haven't had anything that you would say was remotely untoward. And so we do restrict it to the UK, and one of the reasons for that is Companies House, because A, it gives us the ability to analyse which companies have sufficient shareholders to be interesting. So we regularly run target lists of all the private companies in the UK that have more than 100 shareholders, and we'll go out and approach them to say, look, you've got 100 shareholders, you've been going for 15 years, there's no liquidity. Is this not something you should think about for the benefit of your shareholders? Barrel and Stone, another interesting. So we do very little fundraising nowadays. When we first started, we did a little bit of fundraising because we have a network of high net worths. We're much more driven by secondary liquidity now. But what happened with Barrel and Stone, we raised money for them, but then one of the founders decided to leave the business. And so we were able to place his shares with a group of investors. So we do some effectively secondary placings on behalf of former directors, or it could be employees who've left, or whatever. What was I mentioned earlier?
That's the end of yours.
Oh, that's the end of me.
Cool.
Can I just ask one other question, please? What percentage do you think of the companies that you have pay dividends?
A good question, to which I don't know the answer. If I had to guess, I'd say it's 10%, maybe. Because, I mean, interestingly, Integrafin did pay a dividend. And I'm just trying to, there are certainly a couple of others, because we're having, Isles Scilly pays a dividend. Isles Scilly is interesting. It's it's the main way to get backwards and forwards from the Isles Scilly, and if you own shares, you get a discount. So lots of residents of the Isles Scilly are shareholders, so they can get the discount when they go backwards and forwards to the mainland. But then, of course, if they if they move house and move back to the mainland, they don't want the shares anymore, so you need to have some sort of liquidity venue for them.
How do you settle? So if I want to buy, you're a seller and I'm a buyer of Arsenal for £1, I pay £1.03.
Yeah, so
plus stamp duties. How do you settle?
So the vast majority of the companies on there are Crest.
Yeah. Right.
So actually, the way the platform operates is, we don't have, our clients are the companies. We don't have buyers and sellers are not our clients. We may provide them with the information to try and make a decision, and the ability to look at the order book to make a decision about where they want to buy and sell. But the orders all come in through stockbrokers. So if you wanted to buy Tottenham Hotspur shares, you could ring up Pamela Gordon or whoever your stockbroker is and say, I'd like to buy 1,000 shares of Tottenham. And they go, okay, yeah, they trade on Asset Match. There's an auction closes in 2 weeks' time. You would need to put sufficient money in your account before they put the order in, as if you were buying Vodafone.
That's the only way to do it?
Yeah.
Right.
If you were a seller, they'd need to have your share certificate.
I got you. In their hands.
And then they settle T+2.
Yeah.
I mean, in settlement terms, it's like buying and selling Vodafone. Now, there are a number of ones which are not Crest eligible, and then it is a much more long-winded process. I mean, the arriving at the trading price is the same, but then the company would normally orchestrate the settlement process. And we would either use an outside clearing agent to handle the funds, because we don't handle client money, full stop. But the majority are Crest.
Okay.
Are you contemplating at all a scenario whereby either, you yourself would actually associate with, I don't know, something like Pisces or another company in order maybe to gain standing and strength and validation, if that's the right word?
Well, yeah, we've been thinking that would happen for most of the last 10 years. I think, what do we think will come out of Pisces? There will certainly be more competitors. The London Stock Exchange, I think, have made it clear that they will become a Pisces operator. So Pisces is a regulatory system. So so we will become a Pisces operator. The stock exchange will become a Pisces operator. As I said earlier, our expectation and hope is that the size of the space grows in a more significant manner than the number of competitors. So we think it will be, despite having large competitors, and the London Stock Exchange does some things very well. I mean, it's a huge data business. There are a number of other things it doesn't do terribly well. And so I don't think we're particularly worried about them as a competitor, but I think the implications for the space are hopefully profound. And then it may well be that somebody does come along and says, we should be doing this and you're the easiest way to do it, which would be excellent. Then I could retire.
Thank you.
Can I just ask you about valuations? So compared to an AIM valuation for a stock, when a stock trades on asset match, are the valuation metrics comparable, or are they?
Well, that's a good question, because I mean, liquidity discounts go across a vast range of different. So if you take the price at which a company's bought, taken over, as being the sort of ultimate liquidity event, and that's 100% of its value, let's assume, because that's happened. Even something that trades on the main market has a 5 or 10% discount to that, and on AIM that discount could be 20 or 30%. I mean, I think we normally say it's 30 to 50% is the, and if you take Tottenham Hotspur, trying to think what their market. Am I going backwards here? So I think the market cap at £2.60, if my memory is correct, is about £600 million. If somebody wanted to buy Tottenham, it's got quite a lot of debt, but they'd probably have to pay a couple of £1 billion to buy it. But that's the sort of height of the. So 600 to $1 billion is probably where you'd expect Tottenham Hotspur shares to trade in this sort of environment. So yeah, it is. There is a meaningful discount, and that's one of the attractions for buyers, for investors looking at these companies, is that these are not early stage businesses. They've largely been de-risked, and so what you're buying is something where the final liquidity answer is unknown. And part of the skill of investing in these things is trying to work out, okay, when do I think the final liquidity event happens? And Brewdog is a very good example, because they took private equity money in 2017. I think almost everybody thought that they would have been acquired by 2022 at the latest, 5 years after the private equity. And they still haven't been. And in fact, private equity is now really starting to hurt the other shareholders. So assessing that point in the future is a big part of the skill. And with a company like Wadworth, which I mentioned, there probably is no point. So that, to come back to your question, if they're not paying a dividend, they're probably not that interesting.
How do you deal with companies with complex cap tables and multiple share classes?
Yeah, well, a lot of companies do have multiple share classes. I think we do try and provide liquidity in 3 or 4 different classes of shares. In most of them, there is one share class that needs the liquidity more than the others. Sorry to keep harping back to Brewdog, but Brewdog has A shares which were into founders and staff. All their crowdfunding was B shares, which is where the 235,000 shareholders are. So we provide liquidity in the B shares. We occasionally do and try and do some in the A shares, but it's by appointment only. But the main liquidity is in that share class, which represents where there is the need for liquidity.
Thank you. And my final question, can you talk just a little bit about the user experience from a buyer and a seller? Somebody who's thinking about either staying with a company that's delisting or perhaps investing opportunistically in something that in company that's already on.
Well, I think the important part for a seller, I mean, for the seller, the fact that we exist actually gives them a choice. If we don't exist, they don't have a choice. They've got the shares and they're going to keep them until then. So we're giving the existing investors a choice. They can look at it and go, okay, I invested for this reason. It's happened. It hasn't happened. I think it's going to happen. I don't think it's going to happen. I'd like to sell some of my shares, but not all of them. Whatever it is, it gives them some choice to make an informed decision as to whether to hang on or head for the hills or do a partial exit. In terms of investors, I think as I said earlier, the key point is these are not startups. They are largely established businesses that have, to some extent, been de-risked, and they trade at a significant discount because of the illiquidity of their shares. And so there are some really interesting opportunities in amongst that.
Okay, I'm going to make this the final question, if I may.
Yeah. Just looking at that top woman, who actually puts in the order? The broker?
So they send them across electronically to us, and it automatically gets uploaded.
Okay, that's fine. That's
Fantastic. I'm going to call a halt, if I may. It's 10 to 8, and there should be wine and eats ready for us. Iain, thank you very much indeed. That was very interesting. Thanks.